Hi, everyone. Hello, warriors, traders. We have a very interesting guest with us today that I found on Twitter. Welcome to TradeGATEHub, Steve St. Angelo. How are you, Steve?
Oh, Dale, doing great, and I appreciate you inviting me to talk about some interesting things that we tend to like about gold and silver and oil in the markets.
Okay, so yeah, gold, silver trying to reverse head to the upside. You know, before we get into it, basically, do you believe, Steve, that if you get the dollar right, you get everything right?
Uh, that's yes, and I would say it rhymes, but sometimes it doesn't, right? Because
You're right.
gold can trade in the opposite inverse to the dollar, and sometimes
Right.
it'll trade along with the dollar as well as oil. Oil has tend
Yeah.
to trade in the opposite inverse relationship, but boy, sometimes recently it's been
Yeah.
trading with the dollar.
Yeah, one thing that I've looked at historically is that you're right. We can have a bull market in the dollar and gold at the same time, but rarely has there ever been a bull market in silver without a bear market in the dollar. So, just something that I've seen over time, and I just don't think the dollar's done yet. But what's interesting to our viewers and to me, Steve, we all have walked the long and broken road, the winding trail, whatever you want to call it in this industry. I think it takes a certain personality that can persevere, that can live through adversity and learn to get up off the mat if they get knocked down. So I'm always curious about the embryonics of how it started for people. I mean, did you know when you were in, say, the university that you wanted to be involved in commodity and financial markets? Uh, what were you thinking back then?
Dale, actually not. I was a late comer. I didn't. I actually started investing in silver in 2002, and I know
Okay.
that I purchased my first 100-ounce bars at $4.52, and I did it like everybody else did, who continues to get into precious metals, and that's they're worried about the
Yeah.
debasement of the currency, all the debt, the treasury debt, and all these different aspects. So that was the main reason I got into investing into precious metals. But you know something, as time went on, Dale, I couldn't figure out, no one could really give me a good answer why gold and silver traded the way they did. I mean, you get some cup and handle formations and all these different. And so that's why the chart you see in front of you, I did the research and I found out that the gold and silver tend to trade around their cost of production. And it makes perfect sense too, because the entire world the market that we trade the goods and services, it's based on what it costs to produce them and then supply and demand. And then the profits along the supply chain. And so there's really nowhere you can get massive profits. Then you're going to get new companies come in and they're going to have lower prices and they're going to destroy excessive profits. And so,
So it makes me sound like there's no reason to own miners then.
well, you see, maybe when we get towards the end of this discussion, I think there's a really good reason to own the miners.
I
But
do too.
if we look at this chart,
Okay.
I
I see
figured
it.
out that I took home stake mining and I looked at the top gold miners and I went back and I figured out their total cost of production, not their cash cost, not their own sustaining cost, their total real cost. And right now, Dale, it's about 1650. And
Yep.
so there's a reason that this price chart is behaving the way it is, because if we're going to want to buy gold, by God, we're going to have to pay the gold miners what it costs to produce it. Or if we're going to buy other things, whatever the commodity or good is, if you want to continue to buy that, you're going to have to pay what it costs to produce it.
So
And
are you saying because so I have seen times when the cost of production and the gold price that there's a big spread, and I've seen times where the cost of production and then what it costs other people to bring it out of the ground is much more. It's like the efficiency of a particular mine. Don't you ever see, um, you know, uh, gold priced at uh, I'm talking about miners now, where they could have a production cost right now of 1,300 rather than the average of a little over 16, like you say?
There are some mines that have a lower, let's say, all-in sustaining cost or a lower cost, but the all-in sustaining cost is not their total cost. And there's like
Interesting.
we could spend a half hour on that one.
Yeah, okay.
And the issue is it's the same with the silver miners, but the silver miners are different than the gold miners because most of the gold miners' production comes from gold. Silver,
Yeah.
it's sometimes it's like half or less. And so the thing is, even though there's some mines that have a lower cost of production, when you average it all out, and I'm talking the top 6 or 8, we're talking 1650. And so
Okay.
I continually get people send me, well, Steve, this company's doing it at much lower. And
Okay.
when I look at the numbers, 1650 is where it's at. That's
Oh,
a
I
bit,
mean, that's a pearl for me, Steve. You
yeah,
know, you opened my eyes to
and
something.
and so if we go to the next chart, which is silver, if we look at the primary silver miners, including Fresnillo, which is the number one primary silver producer,
Was that the one in Mexico?
that's correct.
Okay.
When I right now, my cost is about 22. All cost, total cost, and all the silver miners except one, and Fresnillo does not come out. It only comes out with biannual financials. The only one that made a profit was Fortuna, but Fortuna should be called Fortuna Gold, not Fortuna
Yeah.
Silver.
Okay.
And so that's why it's done better because it's got 3 gold mines now. And so right now, when you look at the top silver miners, it's $22, Dale. But what I found with the silver miners is more volatile. You could see their price, you could see the silver price go below the silver miners' cost of production. You don't really see that with gold.
Okay. I know that they've all gotten religion. They used to be debt laden, a lot of these miners, and there are
Yes.
things like B2 gold, no debt, actually pay a dividend, a yield, and I think the complexion has changed that uh, they learned their lesson about debt, and most of them do not carry a lot of it anymore. Not to the extreme they used to. That's what killed them in the last cycle.
Yeah, because you're right. During the last cycle, when the price of gold really went up, Barrick and Newmont, a lot of the miners, they did a lot of capital expenditure and added a lot of debt and acquisitions, and they found out they didn't really get a lot of new production. And so now there's not a lot of new production coming online. And so what we're going to see is a decline in gold production in the next several years because there hasn't really been any new discoveries. And so it just costs a lot more to produce gold and silver.
And isn't that also oil a big factor in
Yes.
and
Yes.
so wouldn't a bear market in oil actually lift the margins of miners? We kind of broke down over 80. I'm interested in your view, but you know, there are a few things, Steve, right now that not many people are talking about, like the weakness in copper. And the same story you get with precious metals, you've heard in copper for the last few years, and they've had a nice run, but it's sitting there, it's been under pressure. In fact, I hear Dr. Copper was sued for malpractice by impersonating a bull market. So uh, anyway, I mean, so copper has the same story. There aren't a lot of mines coming online. And the oil weakness and the copper weakness and the big rally we had in equities last week without China's participation almost tells me like there's some type of little, maybe little, deflationary pulse about to hit the markets. It's not a bullish formula for equities, although they've been able to resist it. But what interested me was your narrative about how oil is really the most important component of global economies, even more potent with the effect of oil than central bankers.
You said it perfectly, and it's a perfect time to say that because the next chart I'm going to start with this. Jean-Marc Jancovici is a French engineer. He did a presentation in front of the OECD back in September 2019. And
Okay.
what he showed is there's a direct relationship between energy and economic growth. And so simply all this chart is showing you is total world oil consumption 3-year average and total world GDP per capita 3-year average. And so when you notice when there's growth in oil consumption, there's growth in GDP per capita. And it also, when there's a decline. And so there is actually, Dale, a 1-to-1 correlation with oil production growth and GDP growth until you start adding debt. And so when we understand that there is no, I call it energy tooth fairy, that all this is really driven by oil, and oil is the number one because oil actually allows other energy sources to be extracted. Like China is the largest producer of coal. And the only way they can do that, Dale, is they burn a lot of diesel by extracting the coal with their diesel equipment, transporting that coal on trains and barges and trucks. And so you can't really increase your coal production unless you're burning a lot of diesel. You can't do that without the diesel. So oil is the number one factor. And so when you go to this next chart, we could see it here. And basically what I've done to simplify it, this is total real US domestic GDP versus public debt, which is in red, GDP is in the green line, and then total energy consumption. And I am including total. I did that on for a certain reason. But if you just look at the yellow and green line from 1950 to 1980, you're going to see that energy growth and GDP growth mirrored each other because that's the way it's supposed to be. But after 1980, especially we had the massive inflation of oil and commodities, we saw the debt started to grow. And then you'll notice that even though we had energy consumption fall during the recession in the early 80s, it started to pick up. But you'll notice the GDP from 1980 to 2008, what is it doing, Dale? It's mirroring the increase of debt growth. And after the 2008 financial crisis, this is when what I call, which is my trademark. Well, it's not my trademark. It's Charles Hall. He came up with the energy return on investment. I use that term because it's very important. We got into serious trouble with the energy return on investment of oil. It's not just barrels of oil that are being produced. It's the quality of that oil. And the only way you can make that function is by adding the massive debt. So we added all that debt after 2008 to keep GDP growing, but we have all this massive debt now. And it comes to a lot of your questions about the dollar, about the US Treasury, if we're going to go into a recession, deflation, what is that going to do to the silver and gold? And I think you're right. I think initially we could see weakness. The problem is we're going to get into trouble with oil production, and they can print money and treasuries and debt, but they can't print the oil. And this is very inflationary.
Yeah, you can't print corn either.
No, you can't.
All of those, the Fed can't fight the battles of certain resources, and especially Mother Nature. That's another sector that's starting to light up for me. But I wanted to ask you, how do you explain the recent weakness? And really, the peak was during the invasion. We had that little double top at 120 and sold off to about 60, with the SPR being depleted. But as of late, the market is really aware of Saudi cuts in production. And yet at the same time, and then you have a war in the Mideast, and, it's not affecting oil at this time unless they jack the Strait of Hormuz. Why is oil falling with production cuts? Is it economic weakness? Is it one of your lines here, consumption falling? Because it's not supply growing. So why are prices declining now?
I heard your interview with Luke Groman, and he made a pretty interesting, he had a pretty interesting notion that he believed that it may have been the plunge protection team, because something, I follow a certain amount of individuals, and the oil inventories and global inventories are continuing to decline. And so also demand isn't really weakened year over year. It hasn't really weakened. There's probably other options. I know Dr. Anas Halaji talks about these different options. The these I
So
think
you think it's financialization that's keeping it down?
even the Saudi oil ministers said the same thing. Is he pushing his book? Could be, but when you look at the fundamentals, I knew natural gas was going to be weak since the early spring because of the supply demand fundamentals. Even though it's hit 350, I think we could still see lower natural gas prices before they start moving up, depending on what happens with Europe's weather and the United States'
Yeah.
weather. The issue is, Dale, I think this is temporary.
Okay.
Because what happened to Europe, I call it my terminology is we're hitting the energy cliff. And that means we're running out of growth. And so once that happens, things get very volatile on the way up and down. Very volatile, prices do. And
Okay.
let me move forward. And I want to show you this chart in a second. But if we understand, Dale, that oil is the most important factor that drives the economy and GDP, where did it come from? And so when you look at this chart from 97 to 2008, where did the growth come from? The rest of the world, which is in the olive color. Blue is US, red is Canada. There was really no growth. Matter of fact, a little bit of decline in US and Canadian growth in this first half. The second half, it totally flipped. The rest of the world really didn't increase production. It was the US and Canada oil sands, but mostly shale oil. So if we have had economic growth since the 2008 financial crisis, we can thank the US shale industry because that's where the growth came from. So if we know that's where the growth came from, we need to understand what is going on with US shale oil. And to tell you the truth, which most people don't realize, the oil companies are like busy rabbits and they have built production, but to keep it there, this oil suffers a 43% annual decline rate, natural decline rate. So if they stop adding wells, it loses it. 3.2 million barrels a day of this production is gone in a year.
Wow.
And, yes.
So it was quick to bring online and has no staying power. These wells just empty themselves out pretty quickly, huh?
They empty themselves out. And I will tell you honestly, I underestimated how much growth there would be there, and it grew. But you could see if you look at the chart, and I'll just use you could see this is the decline rate of these things, and they're actually becoming more severe. And now they're doing more things to try to offset these declines. And then we can see that these are the four major fields: the Bakken, DJ, Niobrara, Permian, and Eagle
So
Ford.
this was like QE for the economy.
Yeah, that's a great way to put it. This was QE oil, which really up until recently wasn't profitable. Two of the larger Bakken producers, the Whiting and Oasis, went bankrupt. And
yeah,
which is the largest shale gas producer, Chesapeake, also went bankrupt.
Yeah. Wasn't what was the year when WTI went negative? And that's when I believe Saudi production was intent on putting the shale producers out of business.
Well, that was during the see right here in 2020, where you see that big that was the
before
pandemic
COVID. Before that was
COVID.
Okay.
That was the shutdown.
Okay, got it.
And so now what I've done in this chart, I have removed 2022 and 2023 just to show, because we still had growth, just to show the natural decline rate. And I don't want to get too technical, but all the growth has really come from the Permian, which is the big daddy. And it's one of the largest oil fields really in the world. It's producing more oil than the largest, the Ghawar, which was Saudi Arabia's largest field. All this, what I'm trying to show you, people say that we hear a lot of news about the shale industry is getting more technology, more efficient. No, they're not. It's actually the exact opposite. And this is the Permian's cumulative oil production in the first 3 months, because that's when it's the greatest per 1,000 feet of lateral. And what we see, basically all you have to do is, it peaked in about 2021 and it's been coming down. So they're doing a lot of things, Dale, to get more oil, but it's not more efficient. They're losing the battle. And this next quick chart is the Eagle Ford, because there's two big shale fields in Texas. In the right hand of Texas, the eastern side, it's the Eagle Ford. The left side, and in New Mexico, it's the Permian. Eagle Ford peaked, and you could see how bad it's getting.
Well,
So
these guys that were talking peak oil a long time ago, they ended up being right.
they
They
and
just didn't get the cycle right about when things were just gonna, $200-300 oil,
you
etc.
you know that, because I get this all the time, because I try to talk in details, because it's the devil's in the details, and I imagine you know that. That's so true. The devil's in the details. The peak oil analysts that were talking about peak, they were talking about conventional, and I'll get to that in a minute. But this shale oil, it's a low energy return on investment, and it only works with a lot of debt. Conventional wasn't that way. They made a lot of money. Most companies and individuals, the wildcatters, they made a lot of money producing conventional oil. Not so with shale. And so if we look at this next chart, what goes up, and I imagine you agree, comes down in the same fashion. So
Okay.
conventional peaked in 1970. We had another little peak here because we brought on Alaska. But these conventional wells and fields don't last forever. Wish they did, and they decline in the same fashion. So if shale oil, which has a 43 to 45% decline rate, if that's where all the growth came from, Dale, the downside is going to be very similar. And so what does that look for for America in 5, 10, 15 years? So most of that growth is going to be gone.
Yeah. So no growth of oil production, even if the Fed was out with bazookas, is not going to we're not going to have any growth.
The reason for that, and I tried to explain this, I did the Silver Symposium. The most, like in the Bakken and in the Permian, most of the production, like in the Bakken, comes in 4 counties, even though there's 20 counties. All the companies have focused in those 4 counties. The reason why you start to go out, doesn't matter how much higher the oil price gets, Dale, because when the oil price gets higher to 100 and you say, well, we can go out to the less economic counties, the pipe goes up, the drilling rig costs go up. And so it's like saying, I'm doing gold production in this very good gold mining area in this county. And right now it costs $16.50 to produce gold in that county, and I'm getting $19.50 for it. I'm making $300 profit. But I want to go out to the other counties where it's less profitable, so the gold price goes now to $2,500. But guess what? Or let's say $2,200. When you get out there, the cost to produce that gold is $25, but you're getting $22 for it. Going out to these less economic areas, Dale, is just not economic. That's why they're not doing it. And it doesn't matter if the price of oil goes up. It's just not economic to do it.
But what's actionable about this narrative?
What's actionable is that I believe, I'm not a big believer in owning the shale oil companies, because I think their production is going to start to decline, a lot of these. I think the sweet spots are still going to be the majors, because I think the majors are going to still, like Exxon is buying Pioneer.
Yeah, because Chevron just got hammered, didn't it?
Yeah, but Chevron got hammered, but they bought the right thing. They bought Hess, even though Hess is in the Bakken. Hess is also Guyana, and that is good quality, cheap oil. That's good conventional oil. So there are mergers, but I think the majors are going to do well. But I think I like the Canadian oil sands. And I think they're going to do well for a while the shale companies are going to suffer. But I wanted to move to this because this is what you brought up. If you look at this chart, Dale, the two important things from 1960 to 1970, We had a massive increase in conventional oil production that will never be repeated again. It was one and done. And look at the price of oil. Do you know it remained $1.80 a barrel for that entire decade? We could assassinate President JFK. We could assassinate Robert Kennedy, Martin Luther King, Vietnam War, Cuban Missile Crisis. We had all these, Arab-Israeli War in 1967. Nothing could change the oil price. Nothing, because we were bringing on all this oil, especially from the Middle East. But now, if you look at the right-hand side of the chart, even though we brought on heavy oil, tight oil in red, and natural gas liquids, you see the world is being a bit deceived, because the energy industry, like the EIA, are showing we're hitting 100 million barrels a day of production. A lot of that is natural gas liquids, which does not make diesel. And diesel is what runs the global supply chain.
And we were having shortages of diesel here, about 6 months ago. A lot of the, transportation companies were complaining about it, and truck drivers, what they had to pay for diesel.
And this is what we're going to be facing, because the peak oilers got it right. Conventional crude peaked in 2006 and has never recovered. That's the good quality stuff. That's the high energy return on investment. And that's the stuff that makes diesel. So even though you can bring on all these other energy sources to continue business as usual, this is the issue we're facing. And so the actionable thing to me, and I've got a few more slides, is I see a world that's going to start to transition away from finance into real things, because we're not going to have the energy to settle all that finance. And that is what I'm quickly, the reason why we're in trouble is the world has hit the world's oil industry. If oil is the number one driver of the economy, it's hit the Red Queen syndrome. Not just the United States shale. I showed you shale was declining 43% a year. The entire world is losing 10 to 11% of its oil production every year. And I think this gets into trouble after 2025. And even though we have a recession, we could see lower production. It could push it down a little bit, a year or so. But this is why we're in trouble. And
the debt.
If we understand that global oil production and GDP go hand in hand, you see the first two small lines. Right. The yellow line is oil consumption growth since 2007. And I started everything at zero in 2007. Well, when you add debt, you can inflate the GDP. The GDP should actually, in $1 trillion, should be closer to the growth in oil consumption. But it isn't. It's been inflated. But what's worse, Dale, is total global financial assets. They have grown 10 times. This is the problem. This is treasuries. This is offshore balance sheet, which is the non-financial shadow banking system.
Shadow bank, yes.
This is pension plans, money market accounts. This is all the finance.
This is all the paper.
And so what I say to my subscribers and my followers, we just have enough energy to produce the GDP, which is goods and services. That's basically all we have. And that's all we need, right? It's the food, the goods, the energy we use, whatever we use it for. That's where the energy is being used. It's not going to be able to settle it. And guess what? This is only 281 trillion. The number is over 500 trillion. I haven't include the numbers before 2007.
Okay. Interesting. All right, Steve. So, I mean, that's going to be quite a bit of deflation in financial assets anyway.
Yes. You see, this is where I think we're headed. People still need to eat. And even when we had the pandemic shutdown, diesel consumption, when we shut everything down in the world, only fell 5%. Because you have to keep moving food and goods. We have to still eat a certain amount of things and consume a certain amount of things. So even though you can have a recession, I don't think it's going to hurt as much as people think. That's why I think we're going to see more inflation in things you consume, but less. We're going to see deflation in things that you own, which are assets. Financial assets.
Yeah, anything that needs credit, the credit system.
Bingo. And so I think the last slide I have here is this is kind of my graphic representation of the energy cliff. And so we have built this world on building wealth because you can hear all these people talk about building wealth, and you build real
Yeah.
estate wealth, you build company wealth. But I think that's going to be very difficult if we're not going to be able to grow energy because you really can't increase GDP. You really can't grow. So I think the problem with the dollar, I'm not saying tomorrow or next month or next year,
Okay.
there's too much finance, there's too much money, and there's not going to be enough energy to settle all this. And so I think there's going to be
a day of reckoning.
Yes, there's going to be a global reset that everyone's talking about the financial. I don't know what it looks like, but there's going to be a time when people say, wait a minute, this finance is getting into trouble.
Yeah.
And so they're going to have to tack down. And I think mines, even though they're going to decline, Dale, I think if you have less oil production, you're going to have less production of gold and silver, but at least a mine like a gold mine is producing real gold, real collateral. A U.S. Treasury, to me, is not real collateral.
No.
Especially when you've added 20
it's a
trillion.
con game. You know what they say about confidence?
That's
once people get the con in the confidence, there is none. So I tell you, what an interesting presentation, Steve. You know, most people think that it was a Fed that would take the economy down, or Fed that would create all of this inflation, and this is definitely a unique take on what we have, how we got here, and what could happen afterwards. I really appreciate being able to meet you and present this to people.
Well, Dale, I appreciate you allowing me because there is a lot of and the Fed is kind of moving things around. I do believe that they can move things around, but they cannot change the fundamentals. Yeah. The fundamentals, and then when
they're going to try, Steve. You know, when what you talk about happens and the financial assets come under pressure. I mean, the banks. I tell people, don't bank on the banks.
Right now. I agree with you.
Yeah. So it was really fascinating to me what you did in this presentation, and I hope that people watch it and learn and pay attention to what's happening in long term in energy, because I always thought it was important, but never knew about the correlations to everything you presented today.
So, and one last concluding remark. I didn't realize how much that meant until I went back to the Roman Empire and the late Bronze Age. And do you know, Dale, their economies were all built on cutting down massive amounts of forests to make charcoal, to smelt their gold, silver, and iron and bronze. So their economies were all based on wood fuel consumption. And I have the charts to show the collapse of the silver denarius was all due to the collapse of the Roman wood fuel production because they lost the ability to produce silver.
My trading warrior brother. I salute you, and you're a watchman for people out there, Steve. Best way for people to follow you is on Twitter, or go to your website at SRS Rocco Report and learn what Steve has researched all these years. And I say, Steve, keep an open mind. It'll keep your account open.
Yeah, I agree with you. Thank you very much for the opportunity. Very much, Dale.
Glad our paths crossed, Steve. Thank you very much.
Okay.
Appreciate it, buddy.
Bye-bye.
All right. That's a wrap, everyone. I hope you learned. Play it again if you didn't. And I'll see you with Mike tomorrow morning. Don't just count your pips or your wells or your Krugerrands or your miners. Count your blessings. Adios.